All right. Good to see everybody. Today we're going to be talking about the all-weather strategies. And I don't normally do this at night. So this is my first time coming on at nighttime. Normally it's around, after lunch at 1 p.m. The reason I don't come on at night usually is because I go to sleep so early. But I'm full of energy now to talk about the all-weather strategies. So for those people attending, we're going to talk about an update of performance from August, and we're going to highlight the changes in the strategies so you can ask questions about that and you'll understand, what we're doing. I also want to say that we had a great time at Phenomena on the weekend on Saturday. We had about 100 people in the audience there and another 400 people on the Zoom. And in fact, some of you may have even either been there or on the Zoom. So let me get started. I'm going to share my screen and talk about a little bit about what we're talking about. So hold on one second. So remember to ask your questions in the chat. I love questions. And it was great seeing so many people at Phenomena on Saturday. We had, as I said, 100 in the room and 400 online. And for those that are in Bangkok, let's meet in person on September 23rd. That's the next time I'm doing an event, which is my In 3 Hours team, where I'm going to talk about inspiring a high-performing team. Scan that QR code. You can use that discount coupon and get 60% off. So our allocation strategies are global. We invest globally. Thailand is a tiny part of that global portfolio. So we do have some exposure to Thailand, but not any significant one. We're long-term, gains from long-term equity return while trying to reduce the damage during equity market downturns. And we're diversified globally across asset classes, regions, countries, sectors, factors, and companies. Now, I always like to start by reminding us to remember why we are here, and that is to build wealth over the long term. And we created our strategies for decades. That's me when I was growing up. That's me when I came to Thailand, and that's me at 100. My dad retired at 58 and lived to 82, and he and my mom had 24 years of a happy retirement. That's them at their wedding day. And that's them when I got a photographer to come to their house with me, and they took this great picture. And when my father passed away, I brought my mom here, and my mom's now lived comfortably with me for 9 years, not having to worry about money. Think about living at least 3 decades after you retire. That's how long my mother's been living since retirement, and that's how long many of us will live. And that's the reason why I say that long-term is decades, not years. That's my mom and me at her favorite restaurant, one of her favorites, which is El Mercado in Bangkok. And for some, long-term is over generations. So our goal is to deliver steady returns over the long run. These are our 3 strategies that we have, starting from when we launched each one. We started the all-weather strategy in February of 2019. Now, looking at 2025 year-to-date, the strategies have performed as expected with all-weather alpha focus on top. It's returned 12.3% year-to-date. All-weather strategy is in the middle and has returned 8.8%. And all-weather inflation guard has had the lowest return at 3.3%, but also the lowest volatility. All strategies have had lower volatility than world equity. You can see the brown line that's dotted is very volatile. Now, we mix asset classes rather than hold pure equity. And we do that to try to avoid portions of the down cycle in the market, which you can see we did that in April 2025. But it can also mean that we miss a portion of the booms in the market. So before we go into the performance review, I'm going to go back to see. Let me just go through some of the comments. So Tiradet, good to see you. Thank you. And to learn Pat, I love that you're doing this at night. It's much easier to watch. Yeah, actually 6 p.m. is not too bad. The only thing I miss is, my mom's having dinner outside, but that's okay. That's no problem. Yeah, Lee Rigglesworth, great to see you down in the south. Kuna Tips, Sawadee Krap. All right, nice to see all of you guys. Kanintorn, good to see you. And also, I love you. Thank you. I appreciate that. And by the way, for those people who are considering joining in 3 hours, the code is phenomena, just the word phenomena. Pitch, you're welcome. Nice to see you. And let's see, Pantaka. Oh, yes, good to see you. Some of my Valuation Masterclass Bootcamp students are on the line, so I expect really tough questions. We've got about 138 people on the line right now, and this is a chance for you to ask questions. So it's great seeing you all here, but most important is this is the time to get any questions answered. All right, I'm going to go back to my presentation. And here we go. 1 second. So we have the 3 strategies. The all-weather strategy gained 1.7% in August, but Alpha Focus gained 3.3, and Inflation Guard gained 0.3. So let's look at the all-weather strategy. Since inception, the strategy was up 59.6 and 21.4% above a 60-40 portfolio. This is after our best estimate of fees, and generally almost all fees are in there that we can get in there. So I'm happy with that performance. And in August 2025, the strategy was up 1.7%, which was 0.1% above 60-40. So it wasn't significant outperformance, but it wasn't bad. Now, our 25% allocations to developed Europe and emerging markets ex-China underperformed. And our 25% allocation to gold did well. Performance was helped by 5% allocations to China and Japan, which we missed those, unfortunately, but we're going to catch them, I think. Let's look at the performance of all-weather Alpha Focus, which gained 3.3%. So since inception, the strategy was up 13.7%, and that's about 9.8% above a 60-40 portfolio. And it's 3.6% below world equity, but with a lot less volatility. This is the chart that really matters. If you had just purely bought world equity, you would beat the performance, but you wouldn't beat the risk-adjusted performance, because we have reduced the volatility as much as we can and still capture the upside. So in August of 2025, the strategy was up 3.3%, which was 1.7% above the 60-40 portfolio. Now, our 15% tilt to precious metal miners outperformed massively, up 20.6%. Healthcare did well also. And Europe, small caps, infrastructures, and financials were a drag. Now, the precious metal miners, as you'll see in all-weather Alpha Focus, we're going to be more narrowly focused. Instead of just gold generally, we're going to get narrow in this case and go with this precious metal miners. We wouldn't take that type of risk in all-weather strategy. And the World Equity Fund that we used did underperform, unfortunately. And finally, let's look at the performance of all-weather Inflation Guard. So since inception, the strategy was up 12%. That's about 5.3% above a 40% equity, 60% bond portfolio. The strategy has also experienced less volatility over that time. Remember, this strategy we started for people who maybe have money in deposits and they think to themselves, I want to try to get a little bit more return, but I don't want to take on much risk of the market. And this strategy has less market risk. Now, in August 2025, the strategy was up 0.3%, which was 1.1% below the 40-60 portfolio. And gold was strong, global bonds did well, and our 5% tilts to financials and infotech underperformed, unfortunately. The World Equity Fund that we used in this strategy also underperformed. So before we go into this next section, let me just go in and say hi to everybody. So now is the time. Good to see you, Harshil. Now, let's look at some questions. If you got any questions, make sure to leave them in the chat. And we're going to get into more strategy discussions. So you may have more questions after this. I just want to welcome everybody. If you've just logged in, we're talking about the performance of all-weather strategies. And let's look at, here's a question from Chalern Pat, which says, in AWS, when you want to overweight one asset class, you tend to make it at 25. Why is that? Are there any circumstances that would make it higher or lower? Excellent question. And the answer to this is that it's a balance, and the balance is between, we don't want to be overexposed to an asset and let's say go, let's just say 40 or 50% in any one asset class. And now equity is a little bit different, right? Because equity is the core of the portfolio. So you can assume that we're always going to have a larger portion of equity in the strategy. But let's just look at within equity, we never go above 25%. Now, the thing is when we find through our FVMR model that a particular asset class or a particular instrument's doing well, we will overweight it. But the thing is, if we only overweight it, let's say 10%, we won't capture the upside of that, fast moving part of our portfolio. And so that's the reason why we look at 25%, because that's the balance between having enough in it that if it performs well, it really gives the performance to the portfolio. And also if it doesn't perform well, if we had less than that, we wouldn't be able to capture it. So this gives my best answer on that, hopefully. Next question, John Penn. Oh, that's good. You come to lunchtime, 1 p.m. and the evening. You are always on. Please give your view on gold. What is the expected price? I don't really make price forecasts for many things anymore because I realize it's like, it's never going to come true. And so I think more directionally. And I would say that given the uncertainty with what's going on with Trump, the US, the global economy, I think, there's a possibility that gold can continue to rise. And we're going to play that for right now. Now, remember, we're investing, ultimately, I look at investing on 3-month timeframes. So the portfolio we've just done is for the next 3 months, and then we'll revisit it. So for the next 3 months, my expectation, or the expectation that comes from our FVMR model, is that gold can still be strong. So at this point, we're still positive on gold, but there's some risks that we're wrong on this one. And, one of the big risks is if the Fed lowers interest rates and the US market starts to fly, and, maybe concerns about a recession in America fall. There is one other thing that's kind of an interesting thing to think about, and that is if interest rates come down on the long end, right? Right now, let's say interest rates are about 4% for government bonds on the long end. Let's imagine that they try to bring the long end down, and let's say they lower the short-term rates massively down to 1%, let's say, less than 1%, close to zero. If the Fed could lower rates close to zero, like they did, they left rates at almost zero for many, many years after the 2008 crisis, then it could conceivably bring down the long-term rate, let's say, to 3%. Now, the government, if they want to refinance, they can issue very long-term bonds at a 3% return. That's not bad. And there's another option, and that is that they come up with some sort of yield curve control, in the sense that they decide that they are not going, they're going to force buyers, they're going to offer long-term government bonds at, let's say, 2%, even though the market shows them at 3%. There's a possibility that they force the banks in the US to buy those bonds. And I think that there's definitely some things that Scott Bessent can conceivably do. And if those things happen, they may have averted a US dollar crisis. And if they can pull something like that off, then gold is, going to retreat. And so that's a big risk to me for gold. Ben's good to see you. Yay. All right. So Pantagon says to invest in this portfolio, we need to have a minimum 500. Yes. For this now, both of the strategies, we've got a minimum of 500,000 now. The all-weather Alpha Focus used to be 2 million. Next question. Pira says, what's your view on global petrochem business, short and long term? I suspect that oil prices just stay low because, remember, there's been a huge negative pressure on energy companies because of the climate crowd putting pressure on them. And now that's being released. And I suspect we'll see oil prices down. Generally, lower oil prices can mean, higher, lower inputs into petrochemical businesses, but it also means that's got to feed through to the downstream. So I'm a little bit hesitant right now to be positive on petrochems and energy because I think we still have more supply coming in. But at some point, the multiples of energy and petrochems are low enough that there is a point from a longer term perspective that it may be time to be positive. So that's my best analysis. I haven't looked at it in detail recently, but I did look at the valuations of energy recently. And Salaya says, your allocation in US equity is 5%. You don't see more growth in AI, EV, semiconductors. I think that people look at our calls where we're overweight, whether that's, China or commodities or something like that. And they ask a lot of questions about the overweight. I think your question, Salih, about the underweight US is a great question because it's a huge risk to go to 5% for the US, which we've been at that for a while. But one of the things that I would argue is that it's not such a huge risk because we also have exposure to other equity markets. I mean, just because we don't have a huge amount in US, that doesn't mean that we're underexposed globally. We have equity around the world, and our equity weighting is, 70% or whatever it is now. I can't remember. We'll see in just a second. But the point is that when it comes to the US, AI, EV, semiconductor, I would say the US is extremely expensive for many of these really great companies. The rest of the market's not that expensive, but those are. So if we just look at buying US equity, I think it's very hard to get a positive return over the next, let's say, 3 to 5 years, because you're buying at such a high multiple, and multiples matter a lot. So that valuation gap is a big thing. So at this point, for AI, EV, and semiconductor, we're playing it through China, Taiwan, Korea, and the rest of Asia. Harshiel says, which sector do you think will remain evergreen? I think some sectors, such as consumer sectors, always, do well. And so, but evergreen, I'm not sure. Let's see. Vishal says, amateur question, today's world with AI, will the analyst job still be relevant in 2 to 3 years? I think absolutely, because I use AI every day, and I'm pretty disappointed with it. I think it can be a good editor. It's helped me on some, big scope things. But when I think about the job of an analyst, I think that it also is something that you really have to bring together a lot of different pieces. And what AI is good at is, let's say, following some sort of structure. And so it's possible that it could do that. But the problem is that once the market figures things out, and once AI starts trading more in the market, I think that that's going to actually be self-correcting. So I think there's still room for an analyst job. That's my opinion. Wen says, Hi, John Andrew. Is it too late to invest in all-weather alpha focus tomorrow? I understand that new portfolios allocation was done on last Friday. No, it's not too late. And I'm going to show you a table or chart in just a minute when I get back into the presentation to show you how to think about investing. Now, remember, for everybody on the line, I'm not an advisor and I'm not your advisor. What I am is an advisor to Phenomena. So on your own situation, you need to talk to your advisor from Phenomena or, look at it yourself. But I will present some things that will help you think about that. So I'm going to go back to my presentation. And there's never a dull moment with Trump in the White House. Trump tries to take control over the Fed. And as you know, the key thing is US midterms are in 2026. He's got to get interest rates down. Getting the Fed to lower rates and stimulate the economy will help him to pass the midterms. And it's important to note that, almost every single president loses seats in the House and Senate in their midterms. Like they disappoint. And Trump is trying to do everything he can to make sure that he wins the midterms. And another one related to the question about petrochems, and I would bring in energy. One of the reasons why I wouldn't expect energy prices to go up anytime soon is I think Trump will do something similar to Biden. Before the last midterms, what did Biden do? He and his team, basically what they did is they released the Strategic Petroleum Reserve into the market, which brought down prices, and that the gas pumps, people saw lower prices and they felt like Biden really helped with inflation. And then that probably had a positive effect on the midterms. And I suspect that Trump's going to keep energy prices as low as possible to also boost his possibility. Now, the market is pricing in a 92% probability of a Fed cutting rates by 25 basis points in the next meeting. Now, it's time to announce our new allocations. So this was the slide I was telling you about. We revise our strategies every 3 months, and we are here. So we're right at the beginning. And I would argue that in order to make sure you get the best performance, you want to execute within at least the first 2 weeks if you can. If you wait a little bit longer, you're going to earn a little bit less return. But, that gives you a little answer to your question. Also, remember, we have the automatic allocation system at Phenomena. So that basically allows you to get as close to the rebalance date as possible, as I show here. So make sure you're considering that. I don't know all the details about it, and I don't work for Phenomena. I advise Phenomena, but this is a great innovation because it helps get into the strategy faster, and I know that matters. So, all right, let's talk about our new weights for our strategies. Here we can see in our all-weather strategy, we're keeping equity at 70%, bonds at 5%, and gold at 25%, and commodities at 0%. Now we've reduced developed Europe and emerging markets ex-China to 5%. And we've raised China. So emerging markets ex-China mainly is things like Brazil, South America, developing or emerging Europe and the like. And now we've focused directly on China at 25% weighting versus a prior 5%. We've increased our Asia Pacific ex-Japan, ex-China. This is a strategy that we started with Thales that allows us to strip out Japan and China and Hong Kong, for that matter, so that we can allocate to China separately from our allocations to Asia. And we've switched to FP, CNG, GLOV from SCB, CHAA for the China equity exposure. Now, Trump's tariff certainly bring uncertainty, and markets hate uncertainty. The trade policy uncertainty remains high, and we're expecting continued high volatility in financial markets. Trump's tariffs hurt global trade, right? Even if it turns out that Trump is authorized to impose tariffs or decides not to do so, it still hurts global relationships. And it appears that the market expects that the US will avoid a recession, which constitutes a risk if the Fed fails to avoid it. Now, we think the risks outweigh potential upside scenarios in the US, so we maintain a 5% allocation. Now, before I go to Europe, I do want to go back and talk to you just for a moment about the US, because our underweight of 5% is, there's risk there. We've had it for a while and it's done okay. One of the things that I think is very possible is the Fed could go back to zero or a very low interest rate. And if the Fed goes that low, then, the market is going to fly. It's hard for the market not to fly in that case. And in that case, you could say that we have a risk of our exposure being very low to the US. On the other side, don't forget, we have equity exposure. We have 70% equity and only a small amount that's in the US. So other markets should also turn, right? Let me go back and I'll continue on my presentation. I'll come back for your questions, but please keep the questions coming because they're great. But Europe faces policy struggles. So while the ECB kept its policy rate in July, the governing council members don't agree on the inflation outlook, and Trump's tariffs hurt trade relationships and likely hurt European companies. France is facing political turmoil and concerns about complete government collapse. And we're locking in some profit and reducing our allocation to 5% from 25%. Yen weakness likely leads to more government intervention in Japan. So high volatility in the exchange rate can also have a negative impact on both businesses and foreign investment flows. So we're keeping our 5% target allocation to Japan. Now, a weak US dollar benefits emerging markets and Asia Pacific ex-Japan. And with Trump's tariffs, rising government debt, and a weaker US economic data, we expect the US dollar to weaken further. So emerging markets in Asia Pacific ex-Japan should benefit. Now, through semiconductors, emerging Asia benefits from AI, EV, and tech optimism. Here you can see semiconductor industry billings globally. Korea and Taiwan, where we have exposure, are the first and third largest manufacturers of semiconductors globally, and Malaysia is big too. And we find China and Asia more attractive, and we reduce emerging markets ex-China to 5%, not to be overexposed, in this case, mainly to Latin America. Now, this chart is interesting because it shows that China suffers more from the trade war. The red line is US goods imports from China, and the blue line is US goods export to China. Now, we had a collapse in these two periods of time, but now we have a collapse that's happened recently. You could argue that that recent fall in the red line is why one of the reasons why the domestic economy in China just can't get going. It's struggling. So we're likely near the bottom as far as the impact from trade war. So this is part of the thesis on China, is that there's been a lot of punishment in the economy as well as in the market. And we think that we're closer to the bottom, and therefore it's worth riding an upcycle. So Trump is a deal maker. Of course, he wants to make a deal with China. Both sides feel the pressure to make a deal. And it's likely that we'll see some improvements in the US-China relations. And any positive news related to US-China trade relations should boost Chinese stocks. It's an important thing to note that, when foreign flows switch to buying China, it has a pretty major impact. China has traded at discount to the US since late 2021. Now, that discount of almost 22%, this is on the PE ratio, the CAPE ratio, that valuation gap is significant. But we have to remember also that the US, or the Chinese market, has about 30% weighting in financials, and US probably is at, 10, maybe 15% in financials. I haven't looked at it recently, but I can say that the US, the China, if we exclude financials, that discount's not going to be 21.8. It's going to be less than that, maybe 15 as an example. So with help from Chinese tech stocks and government stimulus, we expect this valuation gap to start narrowing. I think it's unrealistic to expect this trade, this gap to, go back to zero or some premium, but I do think that it has the potential to rise. So we're raising our target allocation to China to 25% from 5%. Now we raise our target allocation to Asia, Pacific, ex-Japan, ex-China to 25 from 5%. Global geopolitical tensions challenge the region, but a weaker dollar could be beneficial. And though the US-China conflict can lead to relocation of production to Asia, ex-China. So expect countries like Vietnam and Thailand and others to benefit. Indonesia. AI and EVs need semiconductors and batteries, and Asia produces much of those. In addition, the region processes many essential commodities and stands to benefit if commodity prices were to rebound. Now here you can see we've kept our allocation to gold at 25%. You can see gold flying recently. We think the momentum can continue, and we also like to keep gold as insurance. So we maintain high exposure to gold in all three strategies. This is a big risk. If gold reverses, it will have a significant impact on the strategy. Let's look at all-weather alpha focus. Here you can see that we've raised our equity to 93%, and we've reduced bonds to 3 and gold to 4. We've added 20% to Vietnam and China small caps, and we've raised precious metal miners to 20% from 15. We've reduced healthcare and infrastructure to 4%, and we've exited financials and Europe small caps. Let's look at this in a little bit more detail. We expect gold miners to move from a beta of greater than 1 time relative spot prices. And if the gold price rises by 1%, we expect gold miners to rise by more than 1% and vice versa. Now, since precious metals appear attractive, we execute the trade through miners and raise our allocation to 20%. Again, we would never have an allocation to miners in the all-weather strategy, but we would in Alpha Focus because we're trying to catch more of the upside and we're willing to take the risk to get a slightly higher return. Now, small caps typically gain more in recovery. Here in AWAF, we tilt 20% to China's small caps, expecting that fund to generate a higher return if we're right about China. But there's also a risk that we're wrong, and then small caps could do worse. So we have risk there in the portfolio. Now, foreign investments into Vietnam are expected at record levels in 2025, and Vietnam's GDP is already among the fastest growing in the region. FDI should help this trend to continue. Now, like in China, the government plays a key role in socialist Vietnam. So the Vietnamese government has shown its willingness to make the country attractive to foreign investors, and the country's also built businesses that are competitive in the global market. Vietnam also, very slight possibility that it could be upgraded to emerging from frontier by FTSE in October, which would lead to passive inflows into the market. So we've added a 20% tilt to Vietnam equity. It is the first time that Vietnam has come into our strategy. And now let's look at all-weather inflation guard. We have a 30% exposure to equity, bonds at 60%, and gold at 10%. Financials, we expect them to benefit from more stable rate environment. While interest rates might be lowered, they're likely to remain high for a while, so that should benefit the earnings of financials. Capital market activity remains high, so financials can benefit from high interest rates and also from fee income. Now, banks lend long-term and borrow short-term, and the yield on the loan book, therefore, reprices slowly. So the Fed controls the short-term rate. Hence, it might take a while before a rate cut hits the financials. So we keep financials at 5% in the strategy in inflation guard. Now, Infotech has driven the market. We think the momentum driven by positive AI sentiment can continue and add a 5% target allocation toward Infotech. So before we get into any further questions, and before you ask, what's your view on Bitcoin? Let me remind you, the Valuation Masterclass Bootcamp 23 starts on November 3rd, and it's now 12 weeks. It used to be 6. We help finance professionals become valuation experts in months rather than years. So in the Valuation Masterclass, you get a 12-week guided intensive online valuation bootcamp, daily live sessions, team support, progress tracking, and to write and present a professional valuation report. In fact, you'll do 4 of them. So get an extra 100% off any price point and great bonuses. Just use the code PHENOMENA. You can either scan the QR code or go to valuationmasterclass.com/bootcamp. I'm looking forward to seeing you there. Now, what's your view on Bitcoin? Well, I don't invest in it myself. If you feel a need to speculate, maybe add up to 3% to your portfolio so that Bitcoin at max, or let's say crypto, is between 0 and 3% of your portfolio. And we don't include it in our strategies, and we can't, since the Thai funds are for sophisticated investors only, so it can't be done through Phenomena for all of our clients. So buy it on your own if you like it. All right, it's Q&A time. Let's go. So let's go through your questions. Keep asking questions, and I'll do my best to answer all of them. Hold on. Let's see. Do you think at this point market correction can be expected in the U.S. and you can have a negative impact on Asia markets like China and India? Yeah, I mean, if there's a market correction in the U.S., it affects everybody. But also remember that markets around the world are not as high in PE. So when you get super high in PE like the U.S., you can see a derating happen significantly. I think you can argue that cheaper markets around the world may not come down as much, but India, yeah, there's some exposure there. But keep in mind that India's correlation to the US generally has been somewhat muted. Taluran Pat says, how do you structure AWS and AF differently? I assume both use FVMR model, but why do the two portfolios look different? So we use FVMR, that's the foundation of everything that we do, but what we're doing in the different strategies is, number one, we have a much expanded universe of instruments or funds that we can go into for all-weather alpha focus. We're willing to go a little bit more narrow and go into smaller markets, go into more niche areas with the hope that that will provide us more upside. The second thing that's different is that we have a 93% exposure. That's like our max for all-weather alpha focus. I think our max for all-weather inflation guard is 85%, and we don't normally get up to that level. It just depends. So that's the second difference. And the third difference is that with all-weather alpha focus, we actually are trying to do a little bit of market timing, like being more aggressive or more defensive depending on our assessment of where the market is. So those are some of the differences. We created them with very different perspectives. And in fact, what I was trying to do when we create them was create them in such a way that they are different, very different. But the key thing that you need to know about all-weather strategy versus all-weather inflation guard is that, let's say you come to me and you say, I have plenty of money and I have a very long-term horizon. What should I own? I would say that in that case, you would be more comfortable having a higher allocation to equity. And so if that was the case, then all-weather alpha focus would be for you. But if someone said to me that I have a small amount that I've saved over the years that I'm living off of, and I have, I'm concerned that an equity market fall could hurt me, significantly, then all-weather strategy would be better, not alpha focus. So it's really a matter of you determining your risk level and then taking a little bit more risk in all-weather alpha focus. In FVMR Asia X, which countries do you overweight and underweight, and why is that? I think I can actually even show you this. Hold on, let me just see if I got this. Yeah, I figured I would get that answer. So why don't we go to that let's go to the presentation for a moment, and let me try to show you that. Yeah, I put this in the back of the presentation, but Korea is overweight. Semiconductor exports continue to grow, and it's the second largest semiconductor producer in the world. And AI momentum brought back demand. And in 2024, Korea semiconductor exports bounced back by 38%. Indonesia, overweight. We're well positioned to ride the global EV momentum. And here you can see known nickel reserves, and Indonesia aims to become a global top 3 producer of EV batteries by 2027. Indonesia has the largest nickel reserves and is the largest nickel producer in the world and the second largest producer of cobalt, both vital for batteries. Malaysia, overweight, to benefit from AI and EV and tech optimism, right? Malaysia is the 6th largest semiconductor producer in the world, and the semiconductor industry contributes to about 25% of Malaysia's GDP. It's the building block of everything from computers and mobile phones to self-driving. So also, Malaysia attracts investment from tech firms in the US and China who have announced billions in capex in the country. So that gives you a picture of our weightings right now. I'll go back to speaking to you. Hopefully that answered your questions. Feel free to continue asking your questions. I'm going to try to answer them now. Let's see. Let's look at some others. I'm not sure whether you already mentioned it, but about the bonds yet. Is the U.S. bonds still a safe haven under this circumstance? I would say that, U.S. bonds are, the reason why U.S. bonds are a safe haven is because the U.S. government can print money. But every government can print money, but the U.S. government the U.S. dollar is the reserve currency of the world. And the result of that is that it doesn't get the selling pressure when they create money, like countries like Thailand, as an example. If Thailand was to print a lot of money, it would immediately impact the value of the Thai baht, and it would start depreciating, and the market would start adjusting for it. So I would say, yes, the U.S. is still a safe haven. And even if things go bad around the world, and let's say the U.S. market starts to fall, you still probably have a flight to quality with people going into U.S. government bonds. John Penn, you can see that I don't have India in the portfolio right now, and I haven't looked at it in detail as to why, but I would say valuation is probably part of it. So my view right now is negative India because it's not in the strategy. So that gives you a little picture. Harshil says, do you think it's better to sit with cash as market all over the world is facing high volatility, and it can be better to invest at market lows? My philosophy is never, ever sit in cash. Always be invested. And now you can adjust your cash levels a bit, but you never want to sit in cash. And the reason is, who knows? Markets are crazy. You think you've got it right, but in fact, you got it wrong. And the result is you could be out of the market at a critical time. So ultimately, what you want to do, I like what Charlie Munger says, never interrupt compounding. You want to be continually in the market compounding, but as we're doing, we're adjusting our level of exposure to the equity market. Next question from Nguyen says, may I have your views on Vietnam equity and depreciation of Vietnamese dong in new allocation? Actually, it's, at this point, we'll see how it goes. I haven't, I don't have a strong view on the currency right now. And I would say that there's a risk, we're going overweight now on Vietnam, just like any other country. But I would say that we're willing at this point to take the risk. And also remember that when we do our FVMR, one of the things that's clear is that with FVMR, we are looking at all markets and we're looking at all factors to try to understand, which is most attractive. So I see attractiveness in Vietnam relative to others. Hold on one second. Whoops, hold on 1 second. Just writing something. Hold on. Okay, let's look at the next question. Next question comes from Joe. Before the automatic adjusts the portfolio in December, do you disclose the new strategy before? Yeah, we disclose the new strategy, and then so the process, Joe, is that we create the new strategy, we bring that to Phenomena. They, through their research operation, they go through our work. We have a discussion and questions back and forth, and then we deliver that strategy to them. So it's always important to remember that Phenomena is our client, not not any of Phenomena's clients. So basically, it's pretty close to the day that we're distributing that you are basically, when the recommendations come out, it's going to be automatically allocated. So it's very close. By the way, on the Vietnamese dong, one of the things is, reason I was just checking was about the level of hedging. And for the fund that we're in right now, for Vietnam, there is hedging. And so the result of that is that if the currency falls, we're still okay. So next is to learn about what is your view on Thai equity? Have you seen any positive momentum factor in it? What's the outlook, the trend? You know, Thailand's a tough one. Personally, I think that Thailand may have another year or two to go down. And part of what concerns me about Thailand is that revenue growth is slow, margin is low, and PE is not cheap. If you look at the PE of the Thai market, it's not cheap. Now, if you look at price to book, Thailand is relatively cheap. But PE tells me, when PE is still expensive, it tells me there may be more for Thailand to go down. Now, don't ask me about government, helping Thai companies. I don't think that that's going to help, even if they said that they were going to do that. What's going to help Thai companies is Thai companies waking up and realizing they have to produce serious profit and growth. And if they don't, then they're in trouble. Yeah, Lee, Vietnam is an interesting play. There's risk there for sure. For those people that were interested in the Valuation Masterclass Bootcamp, remember, that's the link right there, Valuation Masterclass Bootcamp .com/bootcamp, and you use this code Phenomena there. All right. Pitch says, your life going to change after joining just in 1 week. So yes, that's true in the Valuation Masterclass Bootcamp. Rapunzel, hello. Nice to see you. Okay. Pentagon says, is it true the U.S. market trend to slow down in September? And should I take profit right now, or can I still hold existing equities in my port for the long-term purpose? I think that, the U.S. market is very expensive. And we did a study a long time ago where we looked at the U.S. market over many, many years. And we looked at the how we basically broke the market down into quintiles, 5 groups. Group number 1 was when the market was really cheap, and group number 5 is when the market was really expensive. And basically what we saw is that then we said, if you invest in each of these quintiles throughout that period of time, what would be your forward return in 3 to 5 years? And what you find is that it's almost always negative when you're buying at a valuation that's in the highest quintile. Definitely the US is in the highest quintile right now. So I think you need to be careful about US allocation. But I also, as I mentioned before, you got to think long-term. And by thinking long-term, basically what you're trying to do is say, I need equity market exposure over the long term. Now, the way to solve that is part of what we're doing is going after markets outside of America too. Rapunzel, let down your long hair. At the moment, what would be the most suitable investment? Stocks, bonds, gold, Bitcoin? At this point, I'm saying, well, if you look at our portfolio, and I think this is where you want to take your message from, because we're applying the FVMR methodology, and that is stocks and gold. That's where we are. Less bonds, and we don't have any exposure to Bitcoin. You're welcome. Okay. Anita Tom says, what do you think about the future trend of Thai bonds returns? Yeah, I mean, Thailand's interesting because we never really got the inflation after COVID like other markets. And so Thailand was able to keep its interest rates relatively low. But, you know, Thai bond rates are going to have to follow US bond rates to a certain extent. And so, you know, I've seen Thai bonds as particularly government bonds. I mean, I'm mainly looking at government bonds because I'm taking a lot of risk in the equity portfolio. So I can't say I have a strong opinion of that right now, because I would say that I'm positioning the portfolio that interest rates won't come down that much, but I'm also concerned and see the risk that interest rates come down a lot. If we think that interest rates come down a lot, then that means they're probably going to come down a lot in Thailand. And if they come down a lot and you're holding existing bonds with a higher return, then you could do well. Sakurai says, John Andrew, what's your view on India market? Is it considered choice? It is not a separate market in the all-weather strategy. So our exposure to India is going to be through Alpha Focus. And the result of that, although I think we may have some exposure at times to India, but what we can see is that it's really a big part of our Asia 3X strategy that we have. And right now it's just neutral weighted in that strategy. We will be able to do a little bit more of a tilt towards India in the all-weather Alpha Focus, but we're not doing that right now. So the attractiveness of India is not that high right now. Can semiconductors be further invested? You know, I would say that semiconductors, probably the demand is going to be fantastic and it just keeps going. I would say that I'm a little bit more concerned about the multiples of the software companies than I am about the hardware companies. Let's look at next question from Kuna Tip. Says, why do you choose a global bond fund such as KT Bond when Thai bond funds have performed much better and are more consistent? Well, that's a good question. There's a couple of parts to the answer to that. We have at times used Thai bond funds. And so it's not like we can't. But the other thing is, remember, we're global. So we are trying to look global, not invest in Thailand. But we can at times, if we decide to, own the Thai bond funds. Now, also, recently we've been working on developing a new bond fund at Thales that tries to solve some of the problems that we face with the existing bond fund that we're using. And so hopefully in the next couple months, we'll have some news about that, and that may solve some of the challenges that we're facing in the bond strategy. Wen says, thank you very much for your valuable views. I feel more relaxed and confident to invest in all portfolios that you have supervised. Well, I appreciate that. And the thing is that I spend 24/7 thinking about it. I've spent my lifetime devoted to it. But most importantly, I'm a disciplined person. And so between Sornsak and Alex and myself, we've worked together to create a structure, and we follow it. We don't break it. Sakuret says, thank you for your answers. You're welcome. Well, it looks like we got all the questions answered so far. If you got any final questions, make sure to leave them right now, because we're about 5 minutes away and I'm going to wrap up in just a moment. But I just want to say, you know, thanks. This is the first time I've done this show at nighttime. 6 p.m. may not feel like nighttime to you, but for me, it's definitely nighttime since I wake up about 4 a.m. But I have plenty of energy to answer your questions, which is great. Rapunzel says, I sincerely appreciate your kindness. You are welcome. You are welcome. Okay. We got another question coming in from Noop WURL. Hi, Andrew. In the case which equity market is really, really bad, like the past inflation crisis, how much percentage of your AWS portfolio is still on equity? Would you switch to bonds? So basically, with all weather strategy, we can switch down let's say we can bring our equity position down to, I think it's about 65% roughly. So we would go down pretty low in our allocations. And so it's possible, we could get equity down extremely low, right? Our minimum for all equity in all weather strategy could potentially go down to 25%. So it's a balance. We probably wouldn't go down that low, but we would switch to bonds. The hard part to this question is, are you talking about switching to bonds before the market collapses or after the market collapses? That's my question to you. All right. Supercon says, any reason that can stop the gold price? Yeah, if the U.S. economy doesn't go into recession, if interest rates go down, if we see that the Treasury Secretary is coming up with some ideas of how to resolve the issues about debt, which I know he's sophisticated enough to do that. And you can also say that, we've had a lot of momentum in gold. The other thing is just that momentum slows, and that may not cause gold to collapse, but it could cause it to stop its rise, which is what you asked. Just to be clear on our strategy for AWS, we have 25% minimum equity, 90% maximum equity. So to answer the question, we will reduce equity if necessary. All right, let's see. Looks like we've got no more questions. So if we don't have any more questions, I'm going to wrap up this session, but I want to thank everybody who's come on to listen, and feel free to reach out in Phenomena to your advisor and others. And I'm happy to, help if I can. And let's answer this last question, because I kind of asked about it, right? I said, after, I won't ask too much of you to guarantee the future. I thank you for this year's performance. You're welcome. I appreciate that. Yeah. So the reason why I asked you that question is because most people will say, what are you going to do if the market crashes? Well, the point is that in order to really be successful, you have to position yourself before the market crashes. And that's ultimately the goal, is that you're going to position yourself in gold or in bonds, and then the market crashes and you don't get hit. Now, part of the way that we do this is we have minimums. We don't take gold to zero. We don't take bonds to zero. And that protects us on the downside sometimes. But yes, if the market starts crashing and we get those signals in our strategy, I think FBMR will generally put us into, bonds and the like. So that gives you an answer. All right. I want to thank everybody for joining tonight, and hopefully we'll see you again. Stay happy. Don't stress out about your investments. Keep a simple framework and follow it.